2014 was a standout year for the business. With a pickup in economic and consumer confidence spreading through the UK, we were encouraged to see strong demand for prime space from retailers, with the volume of new leases up 23%. And this is now beginning to filter through into ERV growth, with Hammerson shopping centres recognising a 2.6% uplift during the year. At the group level, earnings per share increased 3%, and a significant uplift in asset valuation and continuing income growth drove net asset value per share up over 11% to £6.38. In recognition of these strong results and demonstrating our continuing confidence in the business, we have announced a full year dividend of 20.4 per share, representing a growth of nearly 25% over the last 3 years. Retail Parks had a great year. We secured £7.2 million of new rent from the portfolio, with new leases signed, representing a 6.8% uplift against ERV. Portfolio asset value grew 9% during the year, with refurbishment and re-tenanting initiatives at our centres in Telford, Falkirk and Paisley driving growth. With the regional economic recovery set to continue in 2015 and a growing demand from fashion and homeware retailers to gain exposure to this part of the market, we remain confident that we will continue to generate good returns for the business. Now, despite continuing economic challenges in the French market, trading stabilised during the year. The response to our latest development, Terrace du Port, has been very encouraging, attracting 8 million visitors since opening in May. Now, this demonstrates that consumer demand remains strong for the right retail proposition. The new scheme has delivered over £100 million profit on cost and continues to trade well ahead of our expectations. Across the rest of the portfolio, we continued our programme of enhancing our assets through refurbishments and selective re-tenanting, with the latter resulting in an average sales uplift of 22%. Development work at our Beauvais scheme continues on track, and we look forward to opening the scheme later this year. We are currently on site with 6 developments and have also made real progress on our major London schemes. We've submitted a planning application for development of the Goods Yard site at Bishopsgate, with the plans receiving strong support from the Mayor of London in December. The Whitgift Centre in Croydon, which we're developing in partnership with Westfield, moved a step closer, with the CPO inquiry beginning earlier this month, which should allow us to commence works in 2016. At Brent Cross Cricklewood, our revised planning application received approval from Barnet Council at the beginning of last year. Today we announced the submission of a planning application for detailed works on the first phase of regeneration, and we remain excited about the potential for this scheme to transform the area. With double-digit sales growth across our portfolio, Hammerson's exposure to the fast-growing outlet sector is a key differentiator driving our returns. Over the year, the value of our investments increased 13% and now represent over £1 billion of gross assets. Now, the market is currently highly fragmented, and we see a real opportunity to consolidate the space, particularly through the newly created Via Outlets joint venture. Here, we have already acquired 6 outlet centres across Europe. Via's strategy is to build on this portfolio through 2015 and actively manage the assets, implementing a programme of re-merchandising and re-tenanting to drive greater returns. We expect the outlook across consumer, occupier and investment markets to remain positive in 2015. The combination of low inflation and interest rates, together with real wage increases and falling food and energy prices, will continue to bolster disposable incomes and boost consumer confidence. As a result, we expect occupier demand to remain positive, with retailers prioritising prime locations to showcase their offering as part of a multi-channel strategy. And with significant global capital still chasing prime assets, investment markets look set for another strong year. Against this backdrop, we are confident that our prime retail portfolio positions us well to capture future growth.